Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel. It's our final session of the week and the day, market and sector analysis, and I'm your host, Kevin Horner. I want to thank you all for joining me as we wrap up a busy week. Looking forward to a holiday week on deck, and I hope you all are excited for a little chance to get away, a little weekend here, and then a 3-day weekend coming up. So, going to be great as we really get into the full swing of the summer now. So this afternoon, what we're going to wrap up with is a look at the technical aspects of the major indices in the market. We're going to essentially touch on as many of those sectors and industry groups as we possibly can, try to extend beyond the daily chart into weekly looks as well for a little bit of added context. So today I'm pleased to be joined by Scott Thompson in the chat. Scott, great coach obviously, and hosts a couple of sessions for us each week. You can leave comments and questions in the Q&A, and Scott will get to the ones I'm unable to, but I'll keep an eye on what's happening in there as well. Please take a moment, if you're not already doing so, to follow us on X, Scott Thompson, CS, Kevin Horner, CS, a place to find us when we're not hosting those classes for you here on the channel. With that, let us get to disclosures briefly, and then we'll look at as many of those charts as we can. So first of all, remember that everything we discuss today is considered informational and educational only. We're not making any recommendations here, nor any endorsement. But we are trying to build in some key concepts, key strategies that technical traders are going to monitor, watch, utilize in their own trading, in their own process of evaluating the market. Whether you choose to do that on your end is entirely at your discretion, of course. What we encourage you to do is to learn a little bit about all these various ideas of technical analysis and then apply what makes sense and what seems to work well for you. Beyond that, of course, we remind you, though, that technical analysis is not the extent of everything. We encourage you to make decisions off a multitude of factors, and technical analysis could certainly be one of those, but just not the entirety of them. And so we will probably follow my standardized agenda here, everybody, my Trader Talk agenda, by which we'll go with our broadest indices first, looking at the S&P 500 and the NASDAQ 100, the Russell 2000, take a peek at semiconductors, probably transports too, because we've seen some benefit to the transport space via the sell-off in oil, so that's come to benefit airline stocks and trucker stocks as well. So we'll take a look at all of that with you in addition. So with that, here we go, everybody, into the S&P 500. We'll start us off. It's getting a little bit of selling here into the afternoon, right? Looks like my numbers are a little bit off. Let's just go ahead to a default. There we go. So what we're seeing on here in the SPX, as we'll zoom in a little bit, we had those 3 days in a row running to the gap ledge here. We couldn't get through it, and that led to a little bit of the selling that we've seen today, now opening weekly this morning, but rallying into the afternoon portion of the session, and then in our final hour here kind of finding a little bit more weakness as we round out the week. This has not been a wonderful development, of course. The positives we can take away on the technical breakdown on SPX so far, we could say we did not as of yet make lower lows, right? We are below the 50-day for the first time since we recaptured it back in early April, but we have not made lower lows. And so we could draw in the level here through that last low just so that we know where maybe we start to get a little bit more uncomfortable, perhaps, right? Obviously, we would love to get back above that 50-day, do so with some conviction, but it's going to be tough for some traders today to be buying into the weakness we see at the end of the week. And it's been kind of a stinky one, right? Excuse me. If we put up some labels, it'll highlight the year-to-date change, the month-to-date, the week-to-date. So we're down 2% on the SPX this week and 3% on the month. And if we one of the things we don't often get to in Trader Talk is just the opportunity to see the longer trend. And I'm going to pull us back into that long range trend. This is a 10-year weekly, and I want to point out the distance we have to the 200-week moving average down here. Excuse me. The 200-week moving average below has been an area for participation. We got close to it here back in April of last year. That was the tariff tantrum scenario we played out. And then prior to that, of course, we had this brief little pullback in the end of 23. And then we actually tested it with success in October, the end of 22, in the midst of what was a pretty rough year, basically. All of 2022, we lost a pretty healthy percentage after having rallied back so aggressively following the COVID bottom. But to me, the standout scenario is that we've used that 200-week simple moving average, but we are extended, to say the least. Now, I don't think that we're necessarily looking to find the 200-week moving average, but I think it's important to back off, pull back the curtain a little, and just measure these values so that we know what we are looking at. This could be about a 25% plus move from where we are. That means it would not be out of character in a traditional pullback that went deeper than the standard 10 to 12, maybe 15%. We could easily do a pullback to the 200-week, be in the midst of a long-range uptrend, and it would be felt, to say the least. I mean, we would all dislike that, to say. I think most of us would say we would not like that. Now, the level that many of us traders are keeping a close eye on, I think many traders collectively are looking at 7,000. Remember, 7,000 was the ledge we rallied into and failed at a little bit. We went sideways in there for about 2 to 3 months before we broke down from there, right? So that breakdown gave us the chance to rally through, which we did, but we should not at all be surprised on a possible revisit of the 7,000 ledge. Remember, 7,000 significant resistance, once broken to the upside, can then become potential support. Doesn't mean we have to hold up there, but you all have seen me kind of put that line in there and then point to the percentage move that we've just participated in with a Fibonacci sequence, and look at what we have. The 50% ledge comes right into that horizontal level of support between, say, 69.80 and 7,000. So keep a close eye on that. Hopefully that's not what we're in the midst of, but we do have a lower high at our last peak, and that is the potential setup. It increases our odds for making a lower low following it. So that's what we're looking for. Always be prepared that this could happen. Regardless of what we want, we know better. We don't always get what we want. The market's always right. It's our job to kind of move with it. As you can see in the NASDAQ 100, we've got things a little bit more expeditiously to the downside this week. 4% lower here versus the 2, almost 4% on a month-to-date basis. So we're basically getting that move out this week. Another lower high here as we've pulled back to the 50-day. And I'm going to simply put in a couple of lines, one of which is going to be that last low, so that we've got matching low level. We know where we'd like to get a bounce. And then beyond that, back to the level that we crushed through that built our rally. And that's all the way back to 26,200 or so. Coincident with the 200, whoops, not that way. Coincident with the 200-day moving average. And then one more time, let's put that Fibonacci retracement on this just for a good measure. And you'll see here, it would be a deeper pullback. It would be 61.8% pullback to if we found that last horizontal area right there, right? So I could put a little rectangle on that perhaps just to highlight this for us in the future. It might look kind of like that. Oh, of course. Well, everybody, as you might notice, my lag is kicking in here today, which I always appreciate late on a Friday. Thank you very much. But what we're trying to do is just establish that as a possible zone. As always, my reminder to traders, is that if you're holding positions, your process likely needs to encourage some definition of where you're going to take action, particularly as the market grows weak. A lot of traders like the idea of letting the market break down before they start selling out, and that's perfectly fine. They wait for the trend to actually show true weakness, and one way of utilizing true weakness is to set those varied levels of support beneath you, whether it be a trend line like a moving average like we're using here as we look at the Russell now, or if you're using horizontal supports. Always important to go lower than you really think you could see it. Just so you're prepared for it if it happens, right? Okay, here on the Russell, small caps have been an outperformer. We're very close to new highs. As you can see here, basically made new high just yesterday. That's a new all-time level. And it's largely because, as I see it at least, the Russell has been, or the traders of the Russell really have been telling us something about interest rates. And even though interest rates have remained elevated, as we look at something like the 10-year yield here, they were elevated, but they didn't break higher. We tried to see, we more or less sold the 10-year note down pretty aggressively here. That led to this pop. But what it did was, it looks to me like it created a little bit of an island in the yield. And then that island broke down. What did we do? We rallied right into the resistance zone. What was support became resistance, pulled back from there, broke the 50-day moving average. We like that from a standpoint of supportive action, if you will, relative to the Russell 2000 and small caps. So there's nothing wrong with that. That's a positive here. But I think that's giving some continued lift, and it may very well have been forecasting or foreshadowing a little bit the move that we've gotten in the yields. Because if you were just watching the yield chart, you'd had every reason to believe that the Russell should have been pushed lower, but that hasn't been the case. So now yields are following suit. Russell has been leading and yields are going down now. Okay, how about semiconductors taking it on the chin a little bit here today? I'll slide this over. You can see semis, rough week, 7% down. That's a big move. Obviously, most of that coming today, almost a 5%er, as we're on and now below the 20-day, trying to validate horizontal support in here. But there's some weakness on the chart, generally speaking. But, we're looking at lower highs in the RSI, so we clearly have a divergence here that may very well need a little bit of working off. And if we were going to, give some consideration to a level below us where we could see that horizontal support come in, yeah, maybe those last lows right around the 50-day moving average on the SOX. These four majors, the SPX, the NDX, the Russell 2000, and the semis, are all important to look at that weekly. Look at how extended the weekly is on the SOX. We are from the 200, even at our low. Oh my goodness, it'd be 100 and, no, it can't be right. That's got inverted math, right? So let's go ahead and draw it from where we are to where we may find ourselves, and hopefully not, but all the way down to the 200. What does that percentage come out to? Son of a gun, 60%. So yeah, that would stink, right? So we don't necessarily expect anything like that, but we should be expecting a little bit of breathing room maybe coming into the market. And the last thing I'm going to comment on here weekly, everyone, guys, look at what we're getting from our relative strength. It's on the daily, you look at that RSI so frequently and we get these divergences as we move aggressively to the upside. But it is true that on the daily, we look a little exhaustive. That's fair to suggest with a bearish divergence at higher prices. But I want to point out that the RSI in the semis, the RSI in the NDX, and likely in the semiconductor, the SPX as well, look at where these are residing, everybody. We get them into overbought conditions. That is a strong validation of the trend, okay? That's the reminder that I want to give. It is validating the strength of the trend, but it also might give trend traders reasons to not monitor maybe that 200 period moving average that I'm using on the weekly, but maybe something a little faster. So instead of the 200, maybe traders are going to watch the 100, maybe even the 50 week. Look at where the 100 is. It's also been supportive here on the NDX, supportive on the Russell too, right? Even if we came back, you know what? coming back and testing support is not negative, everybody. That's a positive for us in the grand scheme of things. We need support tests to validate levels of price action where we can believe that traders are going to hold us up or the stocks are going to maintain those price levels. When we find them, test them, it validates that belief, that thesis that we build for ourselves, and then it informs us to then put new positions on, right? Well, that's exactly what I think a lot of traders are wondering about right now. So pick your moving average of choice. Work with the dailies, but also don't be afraid to look over the longer haul. Look at those longer term periods and moving averages that are a little faster against those longer terms so that we can get some clarity here. Like I say, you put up the 50-week on the NDX, and again, it just kind of coincides. And now we've maybe got, I mean, again, a 3,000 point move to the downside is going to stink in the NDX if that happens. But nonetheless, it's certainly within the realm of possibility as traders, and we should be prepared to deal with such moves. Not to say that that's what's coming, okay? But know the level where you would start to believe that that increased probability needs to be met with your taking action in some way, right? So as always, manage our positions, manage our trades so that we're comfortable along the way. And I remind everybody one other thing here as as we move on to transports. Just keep in mind, one of the hardest parts about all of this is taking in all that noise on a day-to-day basis. The narrative, the stories, every headline, etc. We tend to lean on that stuff too much as traders on a day-to-day basis, and leaning into the trend itself, into the charts, can be a little bit more helpful if you're trying to filter through the noise, right? So if you struggle with the balancing act of narrative and price action, well then push narrative a little further to the side and lean more into price action, because as technicians, we believe that everything we see in price is what the market knows about that position itself, whether it's an individual stock, an index, an industry group, what have you. Super important to lean into those concepts. Okay, let us briefly talk about the transports, which are also in a bullish trend, pulling back from a high, but still making higher lows. Very basic technical analysis 101 stuff. So last low was back here somewhere, another one back here. And then right now we're in the process of making a higher low as well, right? After having rallied again. So as long as we hold in and make a pullback that doesn't take us under the 50-day, this is going to be a higher low as well. So this is an improving chart on the transports. I mentioned airline stocks doing really well. Moving to the upside, I drew in a bull flag on this one. This has been tremendous. This week alone, this group is up 10%. I drew in the flag because, well, we had a bull flag break out to the upside, and it turns out that that it made the measured move target right away. It made it over the course, once it broke out, it made it over the course of about 6 sessions or so. That was an incredible move. So as you can see, airline stocks here performing well on the drop, largely in the drop in oil, I believe. We also have, let's take a look at our truckers. Okay, so here you got truckers doing well also, and with a brief pullback to that 50-day moving average. This looks to be like standard structure. Do you guys agree with me? I mean, you're seeing basic moves to new highs, pull back to support. This looks like it was really strong support right at along the 50 there. Let's just put in the 50 exclusively there. And then now if we're doing the exact same thing, of course, well then we might be expecting to find some support in this vicinity, right? Or maybe the lows we've made are the ones that are going to hold, and next week we're going to see the 50-day kick even higher, because of course we're above the 50-day, so we expect prices to continue to rise slowly but surely as we lose the 50th day in the history of this chart from that calculation and add the current value. So, 50 days ago we were somewhere into probably mid to late April. Prices were a lot lower, so we would believe the 50-day moving average is going to keep climbing through here in the near run. But Those aren't the only two, of course. There's also the rail stocks. And so just to keep a close eye on the three legs of the stool, I noted this in Trader Talk this morning with James Boyd, but I've been kind of impressed by the resiliency here in the rail stocks. Moved to the upper portion of this longer run channel. If I made this a 2-year chart, I think you'd see what I'm referring to here. Yeah, so you've got an initial channel that we traded in, got outside of it here, got thrown all the way back to the bottom of that channel before we made another pop here through it over the last 3 months. But what's been strong and surprising, I guess to a certain extent, is this. Basically have held that gap move into the second channel. And I think what that does is it gives traders, again, a level against which to balance risk. And so kind of keeping a close eye on the rails as well, because that kind of gives us a better understanding of economic strength and health also. So are we moving stuff cross country? The answer may very well be yes in the most recent periods here. Again, thinking ahead, right? Thinking ahead, are we still seeing a fairly strong economy in the face of inflationary pressures, which many of you traders are talking about? The possibility for inflationary pressures to start easing a little bit, tied directly to the price of oil. Here we're utilizing the futures symbol /CL. We're not advocating for futures. Remember, you need to be approved to trade futures at Schwab, and we certainly encourage you to do that if you're interested. But what we're going to speak to, just the price of barrels, $69.20. Gang, it was not that long ago when the price of a barrel was as high as 97, and here we are hanging out under 70. We're off about 29% over 3+ weeks, which is a fantastic development for our pocketbooks. For those of us who drive gasoline vehicles, at least you electrics are already consistently laughing on that. I recognize that. That's great. But this is a good development because the move lower in oil is possibly going to give us some data points in the coming weeks that'll be validating the so-called inflationary pressure easing. And if that is the case, you're going to see the market take that favorably and positively. Hopefully that's exactly what we get. I think most individuals expect something like that, but don't be shocked to see some sort of a relief bounce here in the price of oil. Could certainly happen. We are at an important level. It feels like the whole thing has kind of been now suddenly a nothing burger as we've moved all the way, basically the entirety of the move, right? From 69 all the way to, what was it, 125 we got as high as, or something like that, I think. 120 for sure. So, and then all the way back. So a complete round trip, and I'm going to take that as a positive. Okay. Now, let us go ahead and take a peek at the sectors in here. I'm going to use the Market Watch tab. A couple of the developments that I've made note of are some of the things we talk about in Trader Talk as well. And that is look at the 20-day returns on your major sectors here, everybody. Leader over the last month: healthcare, financials, industrials, utilities, and real estate. That is 5. Your top 5 are defensives. Your bottom 3 are your traditionally risk on, right? Communications, discretionary, and tech. So we've taken it on the chin in those big 3 over the last 20 days, the last month plus. It's been a rough month, but this is potentially a validation of some of these charts we've been seeing. Notably, we talked about healthcare. Let us just look at our big movers today. Here's the healthcare chart, moving to new highs. I mean, we're basically dabbling with a breakout here after, what a shock. Shouldn't be shocked at all on this one, everybody. We've already talked about the importance of breakouts and what they can lead to. You got exactly that. Breakout, pause, pull back, test support, validate support, and then we're off to the races once more. How about an 8% pop in the last week in healthcare broadly? That's a fantastic development for healthcare. You are looking at the potential of new highs. On the weekly, boy, does that candle look impressive, everyone. My goodness. So yeah, if we can get through healthcare here, could carry for a bit. That would be an interesting development. Kind of has the makeup, maybe the look of a little bit of a kind of a cup and handle here, doesn't it? something like that. So we've traded through the left side of the cup. Ultimately, if we take out the handle side on the right here, we absolutely could see a potential move that would be impressive. Now, whether that happens or not remains to be seen. A couple of ways to think about it might be to take a look at the range this group is traded in here. So maybe call it very, round figure 1700 or maybe 1680 to 1860 or something like that, almost 200 points. About 180 to the upside is something that some traders might look at initially as one validation of that. But that's a kind of an interesting development on the weekly here. The others are financials. Really, I hope you guys have been watching and participating in Trader Talk, because I've been talking about financials since this move. Since we broke and held the 50-day. This was a great positive move. I tweeted about this when we tested it, the horizontal support. In fact, I think the moment, now this is maybe a little self-indulgent, I'll apologize for it, but the day that we made this tail, I'm pretty sure as we got down to that level, I tweeted something about it. Hey, this is a big spot for financials, and we have managed to move off of it. We're up about 6% from that spot, and if we go to the highs, up about 8.5. This was a really nice development for financials broadly, but if you just look at what you're seeing here, essentially, what do we got? Well, I got a bottom of a flag in here, and then maybe a little bit of a, like that, a little downtrend line we'd like to get above here. This ledge here is just above 900 or so on this particular index. The sector index, that is, I guess. But it does look like a bull flag, doesn't it? So we're just waiting to see if we can break that out to the upside. 50-day moving average has done really well in the shorter term here on financials, but right now the 20-day is working hard to get caught up to that breakout spot, so it can be part of the confluence of potential support as well. And then after healthcare, we also wanted to look at Staples, and Staples has been a little bit more of a difficult animal to figure out, because the back and forth with tech, we've seen money leave tech and go into Staples on a 1-day, 2-day basis, but boy, it really hasn't taken off quite the way that many traders would have expected. One of the things we can speak to maybe is the solid horizontal support in the vicinity of the 200-day moving average. We could also point out that if we wanted to draw a downtrend line, we could capture all of those lower highs, and we could call this a consolidative triangle a little bit, couldn't we? That seems to stand out here. So on a longer term basis, well, that looks even more interesting, doesn't it? Should we be surprised to see that horizontal support has been tested and held? Now, maybe not surprised, but it is certainly notable that we've not broken down. But as notable as the lack of a breakdown is, it's equally notable that if we went below that level, we could have a significant move in terms of percentage for the Staples specifically. But it also, and I just got done saying, sometimes we don't have to listen to the narrative, but if you're of the belief that the cycle may validate the idea of a little bit more movement into some value opportunities, perhaps. Many of you know the value stocks associated with Staples. They're commonly dividend payers, stocks that are a little bit less volatile, typically with betas under 1 because they don't trade equal to the movement in the S&P 500. Those are ways to maybe slow down a portfolio a little bit if you found yourself a little overinvested in technology of late. As an example, some traders will start to lean into Staples. So when we get to periods of extreme optimism, growth is all that matters. Valuations be damned is the way that many traders think about it, right? They don't care about valuations when stocks are running in strong bull trends. But they care about valuations when those same stocks sell off. And then they comment about the valuations being a reason for pulling back, a reason that this stock can't be trading up here. And then you see, value stock kind of perform a little better in the near term. This has been an interesting development. Basically what we're seeing in here is the building out of what could be a continuation bullish pattern for staples over the longer haul. Very important level of support. We'll monitor that as we go forward in a defensive group, as we know. We should also look at technology. I've drawn in some lines here, but let's go ahead and clean it out. And I'll point to the very first thing. It's really hard to suggest that the tech sector is, not valid to be trading it this way. Guys, this RSI has just made new highs with price. So on a long-term basis, this looks like a validation of the trend. Does that mean it has to only persist higher? Of course not. I think it means that we are perhaps in the midst of a breathing window as we built in a little weakness this week. But if we are in that window of breathing, well, then maybe it's the 50-week moving average that we need to visit. Maybe it's the 100-week moving average we want to see. Whatever the case, pick one of these areas where you're going to start maybe feeling like support has been tested, support has been validated. Where are you going to feel a little better about considering maybe an initial entry? If you've been building cash over this last week, then my encouragement is to stay true to that discipline. If you've used this week to build cash, don't be so ready to deploy that cash immediately, because chances are you've done a good thing by building that cash. Wait for some signal that's going to give you the validation that the trend you are waiting on, right? The reason that led you to selling is ready to rock and roll again before you start really deploying those funds. Okay, let me see here. Let's see. I've got there's a bunch of comments in here. Recently, okay, Zinc, your question, absolutely valid as it relates to the TNX. I don't know why yields are getting pushed lower necessarily, short of an infusion of purchasing in 10-year notes, right? If yields are dropping, well, then it's because we're seeing buying pressure of the 10-year note. That'll take, but I can't validate a narrative behind it necessarily. As you point out, there's a lot of concerning narrative and risk, if you will. Couple of key details that I try to fall back on all the time. We know that the market, the bull market, will climb a wall of worry. What does that mean, though? What does it imply for traders? I think what it reminds us about is that we need to have a contingent in the market completely disbelieving what they're seeing, not willing to participate in the bullish uptrend, keeping themselves from participating and downplaying what they're getting out of the market. They don't want to expose money. They don't believe it can go higher. And only when they shift that bias, they become believers in the market. Only then do we get to the point of true capitulation, and the market does what it always does, which is treats the majority terribly, right? The market's going to do one of my favorite idioms of the market. The market will do whatever is necessary to fool the majority 100% of the time. And so when you think about it right now, the fear and greed index, for example, is kind of high as far as what expectations are, right? There's a lot of fear in the market. And when market has that much fear, in fact, according to the third-party website at CNN.com, extreme fear, we're into that rating right now. That extreme fear is feeding into the bullishness, believe it or not. That lack of belief in the market's ability to move higher is exactly why it can continue to move higher. So try not to fight against that nature, right? When the market is fearful, it does not mean that we are ready to implode. I hesitate to use that word, but I personally often need to be reminded that the market moves in its time frame, not mine. And that is sometimes tough to remember. So that's why we have the levels we use. That's why we pay attention to those price action moves as opposed to anything else, right? Because we don't really know until after the fact. And I see Scott was commenting on this as well. Yeah, there's some hawkishness there. You know, the Fed commentary was a little more hawkish. Expectations potentially for for rate hikes between now and the end of the year. But we'll see how this plays in the form of data going forward, because Mr. Warsh did say expectation is to be data dependent, and maybe the data coming forward, thanks to the drop in oil, will be shifting a little bit. Maybe that helps out. Okay, let's see. Yeah. Oh, yeah. We had the mid-year report yesterday, the mid-year outlook. That's going to get posted to YouTube shortly, everybody. I know we're in the process of reviewing that via compliance, so that'll get added to the YouTube channel here over the next day or two. But so keep an eye out for that. But don't worry. Obviously, Monday morning we'll have. I believe my buddy Brent Moores is stepping in for me on Monday morning to take a look at the markets here in Trader Talk. So if you wanted to see what things look like as we kick off next week, make sure you're ready to go with us on Monday, and Brent will be leading the Trader Talk session. So, okay, so we've taken a look at our major indices. We've looked at the S&P, we've looked at the transports, and we've looked at the SOX. So we've seen semiconductors, we've touched on oil, and we've kind of evaluated what's going on from a sector basis here broadly as well. So let us take a look at a big risk on, risk off potential proxy, and that is Bitcoin. Now I'm going to use the future symbol on Bitcoin here. I wanted to take a look at this because we fell to an important level. Once more, using the future symbol, but not advocating for futures. We're just using price action here. And I think the area that stands out most, obviously, is this downtrend, right? We're in a downtrend short term from the 81,000 we traded above here not that long ago, 6 weeks at this point, and we're back below 60,000. So this doesn't feel great for a lot of traders. In fact, having traded down to make a new low, many traders are wondering, is this the breakdown in Bitcoin that many have been waiting for? Now, the weekly chart tells us that we've been to this level previous. It's been supportive. If I pull this back, let's go ahead and I'm going to extend that line to the left, and let's just note what we've caught here. So we had a double top from which we retreated. This was back in 21, and then again in late 21, and then through here, we were through it, and then we had to come back and test. So that was a little bit of an interesting spot. But the thing that stands out to me as we notice right now, I'm going to zoom in further. All right, so one thing is if I drew a trend line upward through these lows, always interesting how when you take out the trend line, you have to consolidate a little bit, and then you go further down. That's kind of notable. The thing that's standing out right now on this to me is that on the weekly, we've got a possible divergence, okay? Now, next week's candle will be significant for us on that. And then if we look at it on the daily, it's a pretty significant divergence all of a sudden, right? Now, granted, it's only been a couple of weeks here, but new low in price, higher low RSI, and it's happening to bounce at the 30 line. So this is kind of notable. We'll see what happens. What's the first development that bullish traders want to see from Bitcoin here? I think the key in the immediate future is, can it rally sufficiently to make a higher high? Okay, and if it can trade through about 60, let's call it 68. If it can take out 68 to the upside with any close or conviction, we might be able to push back to the top of the range. Okay, and remember, if we are watching it for potential range-bound scenarios, well, the last time we rallied into 81, we did almost get to 70 on the overbought or over the RSI condition, into possible overbought conditions. So many a trader is going to look at the RSI from those standard calculations, right? This being sideways, below the 30 line to above the 30 line can be a buy signal when the price action is at support. That could be said to be what we're seeing right here. And when we reach into the 70 level on the upside, with the RSI, that could become the beginning of overbought conditions, and some traders may look to take some off up there. Not to say that they have to, because one thing we know, overbought and oversold conditions, whether it's RSI, MACD, what have you, stochastics, these can all persist longer than we may expect. All right, and then on the weekly on this, I also reminded myself I wanted to show you guys a Fibonacci move from the most significant levels. So the last low we made was at around 16,000. Okay, so if I just drew the Fibonacci's from 16 to our peak and then just zoomed in to make it a little easier to see here. All right, more or less pretty close to the 61.8% retracement, everybody. And I'll remind you here that the 61.8% retracement by many users of the Fibonacci sequencing, the 61.8% is thought of as possibly the last ditch area for support. If it is commonly thought by some traders that if we trade under the 61.8% on a closing basis, that we can take the price action can be taken right back to where we were, where we drew the line from. Okay, so I drew it from that level because that's a fairly significant one, right? It's, back to, like I said, October of 22, so nearly 4-year rally there. So a breakthrough here could bring some serious capitulation. You're absolutely right, Zank. It's possible, but it's a very important level. Another thought you could also apply is to go back to the last low before that. Not necessarily this one, but the most important one, the last true low we see here way back when. This was in 18. And then draw that same sequencing and then just see if we can get any additional validation in there. And yeah, so we're basically in the range between 50% of the entire move from late 18 through the peak this year, and the 61.8% retracement of the move from late 22 through the peak this year. So fairly interesting stuff as it relates to the Fibonacci sequencing here on Bitcoin. And as you can see, that level when we remove these Fibonacci sequences, you can see still the importance of this level for us. So let's see what comes next week on Bitcoin here. Now, next week in particular, let's take a look at our calendar just to see about setting the table. We are actually, let's go forward 1 week, and still have a couple that are ready to report. But more importantly, I think we've got, if I change this to clear, there we go. We are going to get a JOLTS report on the Tuesday here. We have jobless claims coming middle of the week also on Wednesday. So some stuff that could move markets, but mostly market moving on Tuesday, Wednesday, and Thursday. And of course, reminder, Friday is July 3rd. That is the observed holiday for the market, so the market will be closed. We will be closed as well, not hosting shows at least, so you can expect to see us Monday through Thursday at least of next week, but no shows on Friday. And so with that, everybody, I believe we are just about at time. So I hope this was a helpful breakdown for all of you today. I realize that we often spend so much of our days looking at daily views of the market. I hope the pulling back of the time frame to weekly look can offer a little extra context for everybody. I'll remind you once more to be disciplined in your process, set your levels, know where it is you would like to make changes to your process and plan for your own portfolio, and then work to stick to those plans, everybody. That's the hardest part of it all. Believe it or not, it's not the work we put in, it's the work to stick to the plan of the work that we put in, right? So easily we humans, we tend to make those changes on the fly thinking that we can make a better decision in the moment, and that's just often not the way that it works. So I'll reiterate the importance of planning your process and then sticking and adhering to said plan as best you can. Now, with that, Big thanks to Scott in the chat. Make sure you hit us with a thumbs up. We do get this one reviewed and archived for you into the archive, hopefully, maybe not first thing tomorrow morning on a Saturday, but shortly hereafter, we'll have this one ready to go for you. So I hope you all have a great weekend. Like I said, I'm off on Monday, but I will look to reconvene with you all on Tuesday afternoon. And I do hope you enjoy your weekends, everybody. Stay safe out there. See you again soon.